Hi, this is the second lesson of Introduction to Accounting. That is the ledger and the concept of double entry. So we begin with the ledger. In our first lesson, that is the first lesson of Introduction to Accounting, we defined accounting as the process of recording business transactions in the books of accounts. So transactions are recorded in books. The books in which these transactions are recorded are known as the ledger. So accounting involves the process of recording transactions in the ledger. So instead of saying that transaction involves recording transactions in the books, we can simply say that transaction involves recording all business transactions in the ledger. So in which case, the ledger is the book in which business transactions are recorded. Next, we look at the classification of the ledger. So the ledger, in most cases, it is divided into three. So normally, for big organizations with numerous transactions, it becomes necessary to split the ledger into three so that it becomes easy to record those numerous transactions. Yeah. So it becomes necessary to divide the ledger into three parts. Unlike in small organizations where the transactions may be few, there may be no need to divide the ledger into different parts. But in big organizations, so as to achieve a lot within a short period of time, it becomes necessary to split the ledger into three, such that one person works on one person works on one ledger, another person works on another ledger, and another person works on another ledger. And that way it's easier to achieve, it's easier to record the transactions in the ledger. So we have three divisions of the ledger. One, we have the debtors ledger. So the debtors ledger is the ledger that is used to maintain personal accounts of all debtors. Debtors are credit customers of the business, those persons who have bought from the business on credit basis. On credit basis meaning that they bought on the promise uh, of paying for these sales at a future date. So we sell to them now and they promise and we accept that they'll pay at a later date. So these are debtors. So debtors ledger is used to maintain all personal accounts of all debtors. Debtors being the credit customers of the business, those who have bought from the business on the basis of a promise that they'll pay for these goods at a later date. So they've bought on credit basis. So the personal accounts of debtors are maintained in the debtors ledger. The second division of the ledger is known as the creditors ledger. This is a book that is used to maintain personal accounts of all creditors, in which case creditors are the credit suppliers of the business, those persons who have sold to the business on credit basis. That is, those persons who have sold to us on credit basis. So they have sold to us on the basis of the promise that we, as the business, we will pay at a later date. Yeah. So creditors are those persons who have supplied to us on credit basis, on the basis of a promise by us that we will pay to them at a later date. So in this case, the creditors ledger is used to maintain these persons that sold to us on credit basis. So in the creditors ledger, we have the personal accounts of all our credit suppliers. And then the third division of the ledger is the general ledger. So the general ledger is used to maintain all other accounts of the business. Any other account that doesn't fall under creditors ledger and doesn't fall under debtors ledger will fall under the nominal ledger. So like we have the expenses accounts like electricity, rent expense, transport expense, advertising, marketing expense, stationery, sales, purchases. All these accounts that don't fall under debtors and ledgers and the creditors will fall under the nominal accounts. It's simple as that. So we have all the accounts of the business. From all the accounts of the business, the creditors' personal accounts are taken to the creditors ledger. and the debtor's personal accounts are taken to the debtor's ledger. And then all the other accounts that remain will fall under the nominal or the general ledger. We proceed. The format of a ledger. The format of a ledger is also known as a T account because it appears like the letter T, which is a big T. I know you've come across this before. Yeah, so we look at the format of a ledger account, which is also known as a T account. So a ledger account has two sides. That is the left side that is used to record the debit entries, and the right side that is used to record credit entries. So in short, we note that a ledger account has two sides, in which the left side, your left side that is, your left side is used to record the debit entries, and the right side is used to record credit entries. Note this. The left side is for debit entries and the right side is for credit entries. So it is ruled as below. So we have the big T, which must have a title, and in the title we have the account name. Then we have on the left side we have the debit side or the debit entries. So it's referred to as the left side or the debit side. And then on the credit side, that is the right side, we have the credit entries. And then the entries are made inside there. So we shall have an example to illustrate all this. So above layout is also known as a T account because simply it appears like the letter T. As you can see, this is a big T. So it's also known as a T account. So the ledger account is also rolled as below. So you have is also a T account, but with lines inside. So it must have a title, that is the account name. We still have the debit side on the left and the credit side on the right. So on both sides we have the date column, we have the details column, we have the amount column. So on the debit side we have the date column that is used to record the date at which the transaction took place. We have the details column that describes the transaction, and we have the amount column that mentions the amount that was involved in that transaction. And then on the other side, the same is repeated, the same columns are seen. We have the date column, we have the details column, and we have the amount column. So that is the ledger. So our topic is on the ledger and the concept of double entry. So now we look at the concept of double entry. The concept of double entry, this is a fundamental concept of recording transactions in the books of accounts. So in accounting and in bookkeeping, when recording transactions in the books, we have to follow a rule. This rule is known as the concept of double entry. You remember in our first class, in our first lesson, we had that example that we were working on, and I remember saying that whenever recording transactions in the books or in the ledger or in accounting, we have to, there is the duality concept. Each transaction has a dual effect in the books of accounts, or rather, each transaction has a dual effect in the ledger. That is to say that a transaction will affect two sides of the ledger. Yeah. So in this case, we must have a debit entry, we must have a credit entry. Or rather, you can say that each transaction will have a credit effect and it also must have a debit effect. Each transaction must have a debit effect and must also have a credit effect. So this is a fundamental principle of business transactions, of recording business transactions. That is the concept of double entry. So what the concept of double entry is a fundamental principle of recording business transactions that requires that every transaction be recorded twice in the books of accounts. That is, for every business transaction, there must be a debit entry and there must be a credit entry. For every business transaction, there must be a debit entry and there must also be a corresponding credit entry. So each debit must have a corresponding credit and vice versa. That is, each credit must have a corresponding debit entry. Accounts and double entry. So in order for us to apply the rules of double entry, In order for us to apply the rules of double entry, there are laws to be followed. And in order to understand these laws of applying double entry, we need to first understand the classification of accounts. So in this case, we look at the classification of accounts and how double entry applies in the classification of accounts. So therefore, accounts a double entry. So in order to understand the concept of double entry, it is important to first understand the classification of accounts. So the classification of accounts is as follows. So in order for us to understand the concept of double entry, it is important to first understand the classification of accounts. So the classification of accounts is as follows. So we have this diagram. So the classification of accounts. So we classify the accounts into two main parts. That is the personal accounts and the impersonal accounts. The personal accounts are those accounts that have the name of a business or person as their title or as their heading. Those accounts that have the name of a business or person as their title. So you have an account like, say, Moremi's account, Brenda's account, Mwaniki's account, Uhuru's account, and Ruto's account, like that. So the name of a person as a title of that account. So the personal accounts are classified into three. We have the debtors account, we have the creditors account, and we have the capital account. So you understand that debtors are our credit customers, creditors are our credit suppliers, and capital belongs to the owner, of which the owner is also a person. And then the other classification of impersonal account of accounts we have is the impersonal accounts. The impersonal accounts are those accounts that do not contain the name of a business or person as their title. Impersonal accounts do not have the name of a business or a person as their title. The impersonal accounts are further classified into two. So you have the real accounts and we have the nominal accounts. So the real accounts relate to assets. We all know what assets are. Yeah, the economic resources of a business that have the potential of deriving economic benefits to the business as a result of a past event. So you have tangible assets, you have intangible assets. Tangible assets are those that you can lay your hands on, like fixed assets, motor vehicles, land. Yeah, we have a current assets like cash, like the bank. And then you have intangible assets like goodwill, I cannot touch, but they are assets. Intangible assets like goodwill. And then you have nominal accounts and the impersonal accounts. Nominal accounts relate to revenues and expenses. Expenses are those activities, yeah, that are to benefit the business, but they involve an outflow of cash, an outlay of cash. Those activities that are incurred by the business for its own benefit, but will involve an outflow of cash, like electricity. Electricity benefits the business, but electricity, at the end of the month, you have to pay some money for that electricity that you've consumed. If it's rent, rent is for the benefit of the business. The business has used that building. So at the end of the month or at the beginning of the month, at the end of the day, the business will pay for this rent. Salaries, the business has benefited from the service of the employees. At the end of the month, the business will pay salaries expense. So expenses is part of the nominal account, which is an impersonal account. Expense that is not under the name of a person. It's just under the name of that activity that the business has incurred. And then we also have revenues. Revenues is the opposite of expenses. A revenue is a service that the business has rendered, yeah, has rendered to another person. So, and in return, the business is to receive some cash inflow. So, revenues, examples of revenues is like sales. We've sold goods and services. We may have let a building somewhere we are not using. We've given it to a tenant. This tenant has benefited from our own service. That is a rent. This tenant will pay us a rent at the end of the month. That is it. So the classification of accounts mainly classified into three. That is the personal accounts, and we have the impersonal accounts. Under the personal accounts, we have those accounts under the name of a business or person That is the debtors, creditors, and capital. And then in personal accounts, we have the real accounts, which relate to assets, both tangible and intangible. Intangible assets that cannot be touched, like goodwill. And then you have the nominal accounts and the impersonal accounts, which relate to revenues and expenses. So here, down there, you have the details. So the personal accounts, maybe I repeat, these relate to those accounts whose title is the name of a business or person as their title, e.g. debtors, capital, and creditors. Capital belongs to the owners of the business. And then we have the impersonal accounts. These accounts do not contain the name of a business or person as their title. They relate to real accounts and personal and real accounts and nominal. This is not personal accounts, but rather supposed to be nominal accounts. So these accounts do not contain the name of a business or person as their title, and they relate to real accounts and nominal accounts. So real accounts, this relate they relate to assets, that is both tangible and intangible assets. And then nominal accounts, this relates to revenues and expenses. So now accounts and double entry. Yeah. So remember, our main issue here is the concept of double entry, the concept of recording transactions in the books of accounts following the rules of double entry, whereby each transaction will have a dual effect, in which case there must be a debit entry and a corresponding credit entry for every transaction. So the question here is that when faced with any business transaction, when faced with any business transaction, the following three questions must be answered. The following three questions must be asked and answered. So for you, the student, whenever faced with this question, the question of recording transactions in the books of accounts, you must answer the following three questions. One, which two accounts are affected? Which two accounts are affected? So there must, in most cases, there must be two accounts that are being affected by a transaction. It could be a personal account, it could be an impersonal account, it could be a nominal account, it could be a real account. I hope you are together. So there in most cases, there are two accounts that are affected by a transaction. Yeah. So you need to understand the concept, the classification of accounts in order for you to answer this question. And then the second question you ask, so after you've answered the first question, the second question is what type of accounts are they? So from the classification of accounts, we've seen various classes of accounts. We have seen the personal accounts, impersonal accounts, nominal, real accounts, and so on. So in this case, you have to answer what type of account has been affected. So is it a personal account? Is it an impersonal account? Is it a nominal account? Is it a real account? That is it. Yeah. So what type of account is it? So from the classification of accounts, so you're able to tell that rent falls under what type of account? So rent falls under nominal account. You're able to tell that fixed assets like what? Like motor vehicle. Motor vehicle falls under real account. So that is the question. That is the idea. So what type of accounts are they? And then the third question to answer is which account is to be debited and which account is to be credited. So following the classification of accounts, we can then apply the rules of making double entry. Yeah. So the third question is which account is to be debited and which account is to be credited. So for us to know which account is to be debited and which account is to be credited, then we go back to the classification of accounts. So the following figure gives the idea of making double entry in case of different transactions. So we go back to the classification of accounts. So account and double entry. So which account is to be debited and which account is to be credited for a given transaction. So we go back to our classification of accounts. We still have our personal accounts and impersonal accounts. So the personal accounts, we have the creditors, the capital, and the debtors. Yeah. So under the personal accounts, whenever a transaction takes place, we always debit the receiver and credit the giver. For personal accounts, we debit the receiver and we credit the giver. So the receiver, so say for example, you've sold goods to a customer on credit basis. Your customer has received the goods. So in this case, your customer is the receiver. So therefore, you debit his account. You debit the customer's account, being that he is the receiver. For the givers, you credit the giver. So for example, you've bought goods on credit from your supplier. The supplier has given you goods. So in this case, the supplier is the giver. So in this case, you go to the supplier's account, in which case now he's a giver, and credit his account. So therefore, you credit the giver. So for personal accounts, therefore, in short, we always debit the receiver and credit the giver. I hope we are together. So for personal accounts, we debit the receiver, we credit the giver. So the receiver, an example, is a customer that we've sold to on credit basis. He has received our goods. He is the receiver. So therefore, we debit his account. For the supplier, he has sold to us goods on credit basis. He is the giver. So therefore, we credit his account. And then in personal accounts, and in personal accounts, we have the real accounts, you remember, and the nominal accounts. Real accounts will relate to assets. So for assets, we always debit what comes in, and we always credit what goes out. So for instance, we've bought furniture. Furniture is an asset. So if the furniture, we've bought the furniture has come into our business. So therefore, being that the furniture has come into our business, we debit the furniture account. And in case we sell the furniture goes out of the business. So therefore, we credit the furniture account. So if the furniture has been sold, it goes out of the business. So therefore, credit the furniture account. I hope we're all together there. So for real accounts, we always debit what comes in, and we always credit what goes out. That is for assets. And then for nominal accounts, we always debit revenues and losses whenever they are incurred. So revenues and losses will always be debited, and revenues and gains will always be credited. So this is the rule. For under nominal accounts, expenses and losses will always be debited. Expenses and losses will always be debited. Expenses and losses will always be debited. And for revenues and gains will always be credited. Revenues and gains will always be credited. So we can summarize these charts of accounts in the following table. So we have the account column. We have, in case of an increase in an account, in case of a decrease in an account, in case of the balance in an account. To saa moja hivi jana 10. Yeah, sawa sawa sawa. Okay, apologies for that. So we can summarize the chart of accounts and double entry into the following table. That is the account. The accounts. We have the following three classification of accounts. We can summarize the classification of accounts as we can have assets, we have liabilities, we have capital, we have expenses, and we also have revenues. So we have these classes of accounts. Summarize them that way: assets, liabilities, capital, expenses, and revenues. So in the case of an increase, we always debit assets with increases. In case of decreases, we always credit the asset account. For liabilities, we credit increases, we debit decreases. For capital, we credit increase and we debit decrease. For expenses, we debit increase, we credit decrease. For revenues, we credit increase and we debit the decrease in revenues. So assets debit whenever they increase, credit whenever they decrease. Liabilities, credit whenever they increase, debit whenever they decrease. Capital, whenever it increases, you credit. Whenever it decreases, you debit. For expenses, whenever they increase, you debit. Whenever they decrease, you credit. For revenues, whenever they increase, you credit. And whenever they decrease, you debit. And then for the balances, we are looking at them next. Assets will always have a debit balance. Liabilities will always have a credit balance. Capital will always have a credit balance. Expenses will always have a debit balance, and revenues will always have a credit balance. So next, we look at the balancing of accounts, which give us this column, the balances of accounts. So balancing of accounts. Well, so what does it mean when we say we are balancing of accounts? So to balance of an account means to insert the difference, in which case now the balance. The difference is also known as a balance. So to insert the difference or the balance on one side of a ledger account so as to equate the debit and the credit totals of an account. To balance off an account means to insert the difference on one side of a ledger account in order to equate the debit and the credit totals of an account, so that we have the totals being equal. So you find that in most cases, at the end of a particular period, the two sides of a ledger account will not be equal. So, but we need to equate them. So to equate these totals, we need to insert the difference, which is also known as the balance, in order to have equal totals of the account. So the balance is the difference between the credit, the two sides totals of the account. The difference between the credit total and the debit total of account is the balance of the account. And to balance of an account is to insert this balance or this difference on the lower side of the account in order to equate the two totals of the account. We look at the three types of account balances. There are three types of account balances. That is, we have the debit balances, we have the credit balances, and we have the zero balance. So we begin with the debit balances. Debit balances occur when the debit side of an account is heavier than the credit side of the account. Debit balances occur when the debit side of an account is heavier than the credit side of an account. Yeah, that is when the debit total of an account is more than the credit total of an account. The debit total of an account is more than the credit total of an account. So in this case, we will have a debit balance. That is, we need to add or insert the difference or the balance on the credit side in order to equate the two sides of the ledger. So assets and expenses will always have this type of balance. So assets and expenses will always have a debit balance. The second type of balances is the credit balance. The credit balance. These balances occur when the credit side of an account is heavier than the debit side, with the difference, also known as a balance, being inserted on the debit side. Revenues, capital, and liabilities have this type of balance. So credit balances occur when the credit side of an account is heavier or is more than the debit side. That is, the credit total of an account is more than the debit total of an account. The credit total is more than the debit total of the account. So therefore, the difference will be inserted on the debit side in order to equate the two sides of the ledger, or in order to equate the two totals of the ledger. Revenues, capital, and liabilities will always have this type of balance. So as you can see in our table up here, yeah, in this table, assets will always have a debit balance and expenses will always have a debit balance. All the other accounts, that is liabilities and capital and revenues, will always have a credit balance. Liabilities, capital, and revenues will always have a credit balance. So you need to know that. liabilities, capital, and revenues, we always have a credit balance, whereas uh, assets and expenses, we always have a debit balance. And then the other type of balance is the zero balance. So zero balances occur when the debit and the credit totals of an account are equal. And the difference between the two accounts is zero. The difference between the two accounts is zero, not equal, but zero. Yeah. So we have the two totals of the two sides of the account, that is the credit side and the debit side being equal. The amount is equal for the totals of the two sides. So if it's equal, then the difference is zero. So if you have the difference of two equal numbers, then the difference will be zero. So a zero balance will result when we have the two sides of the ledger account being equal. Hope we are together. Yeah, yeah, we are together. So we can always rewind and rewind and rewind this video until you get it. So zero balances occur when the debit totals of an account are equal to the credit totals of the account. Therefore, being that the difference between the two totals is equal, is the same, because the two totals are equal. So that is the balancing of accounts. Then before we look at an example, we look at the trial balance. So a trial balance is usually prepared at the end after posting the transactions in the books of accounts. So after posting the transactions in the books of accounts, that is in the ledger, we at the end of the period we balance off the accounts so as to obtain the debit balances and the credit balances, and then these balances are taken to the ledger, to the trial balance. So the trial balance is prepared for us to assess the accuracy in recording of these transactions in the books of accounts. So we prepare a trial balance at the end of the period from the account balances to test the accuracy of our process of recording transactions in the books of accounts. We shall prepare a trial balance in an example which will which will help us understand more the concept that I'm trying to explain here. So what is a trial balance? A trial balance is a list of debit and credit balances extracted from the ledger at a given date. So it's usually prepared as a test of arithmetic accuracy. Usually prepared as a test of arithmetic accuracy, as the total of the debit and credit balance, the total of the credit and debit balances must be equal. So at the end, when you prepare trial balance, the debit totals and the credit totals must be equal. So on the credit side, we have the credit balances. On the debit side, we have the debit balances that have been extracted from the ledger accounts. That is in this in the trial balance now. So we shall have an example to illustrate all this. So a trial balance is usually prepared as a test of arithmetic accuracy. So in the end, if you find that the totals of the two sides of the trial balance are not equal, then you know that something is wrong. If the two sides of the trial balance are not equal, then something is wrong. So it means that you have to go back to the ledger and try and pinpoint where the problems are, correct them until the trial balance is balancing, until the totals of the two sides of the trial balance are equal. So the trial balance is also prepared to aid in the preparation of final accounts. Yeah, so in most cases, the trial balance serves two purposes. One is the arithmetic accuracy to test whether the two sides are equal, so as to determine whether our process of accounting is okay. And two, we prepare the trial balance to help us in preparing the final accounts. The final accounts, in which case now here, we have the balance sheet and the trading and the profit and loss account. So the final accounts, we shall cover them in our next lesson. So down here we have the format of a trial balance. So the trial balance must have the title, and in the title you have the business name and in the title you have the business name and the trial balance as at a given date. Yeah, so the date, so a given day of the month, yeah, given day of the month of a particular year. So in the title, you must have the business name, the document that is being prepared, which in this case is a trial balance, which is prepared for at a given particular date. So of a given month, of a given year. So on the debit side, as a rule is, Assets and expenses will always have debit balances. So on the debit side of the trial balance, we'll only have assets and expenses and their balances in the amounts column. And on the credit side, we have the revenues, capital, and liabilities and their balances. So revenues, capital, and liabilities will only be seen on the credit side of the trial balance. Because on the credit side of the trial balance, we have the credit balances. And it's only revenues, capital, and liabilities will have credit balances. So on the right side, on the debit side, we have the assets and expenses balances in the trial balance. And on the credit side, we have the revenues, capital, and liabilities balances in the trial balance. So next we look at an example.